You should be familiar with the fundamentals of American taxation if you intend to stay in the country for an extended period. Taxes shift resources from private individuals and businesses to the government. They are involuntary fees that the government enforces and collects from businesses and individuals to finance government activities based on what they earn, buy, or own. In this video, we're going to discuss the U.S. tax system. The video is going to be amazing, so make sure you stick to the end. Before starting the video, be sure to smash the like button and subscribe to never miss out on any of our videos. In the United States, the Internal Revenue Service, IRS, is set up to collect taxes and enforce tax laws. Generally speaking, the federal government collects income, corporate, and payroll taxes. The state, on the other hand, collects sales taxes, and municipalities or other local governments collect property taxes. In the United States, a person is considered a taxpayer if they meet one of three criteria. They've been in the country for at least 183 days, holds a green card, or are a citizen. After 183 days of residency in the United States during the current calendar year, or 183 days of residence during the previous 3 calendar years combined, non-Americans who do not have a green card are required to file a tax return in the United States. The federal income tax has not always been a part of the American taxation system. Early in our nation's history, the income tax was used only in times of war or national crisis to generate needed revenue. In 1862, Congress passed the first federal income tax law to ease the burden of Civil War debts. This early tax was a progressive tax. It applied only to people who made more than $600, ensuring that the tax was based on citizens' ability to pay. The government relied on voluntary compliance with the income tax. Before it was repealed in 1872, this federal income tax provided nearly a quarter of the war revenue. The federal government, 41 states, and many local municipalities levy income taxes on personal and business revenue and interest income. In most cases, income tax brackets are progressive, meaning that the higher the income, the higher the rate of taxation. Federal rates for the 2021 tax year range from 10 to 37%. State and city rates are generally much lower. In addition, most systems allow individuals to reduce their tax bill with various credits, deductions, and allowances. Businesses pay taxes on their net income. It is important to note that in the United States, taxes are based on your world income. Therefore, you are required to disclose that income on your American tax return if you earned money in both the United States and in your home country or any other country in addition to your home country. By the 20th century, the American economy had grown as a result of industrialization. The federal government supported more people and programs than ever. A flat tax is a system that levies the same fixed percentage rate on every citizen, regardless of their income. A flat tax system requires all taxpayers to remit the same percentage rate, no matter how much they earn. Most flat tax systems exempt those living below the poverty line. Many U.S. states and several nations use a flat tax system, including Russia, Latvia, and Lithuania. Payroll taxes are taxes deducted from wages and salaries of employees by their employers on both the federal and state levels. They go towards financing social programs, such as Social Security and Medicare. Payroll taxes are regressive and require only a tiny portion of your wages. Income and payroll tax are technically different, as payroll levies are relatively simple, but income taxes are complex and flexible. While income taxes are levies imposed by the government, they depend on various factors and make up the bulk of your tax return calculations. Every community can levy what is known as the community tax or the local tax. As a result, it's not present in all towns and cities across the country. The revenue from the local tax can be used for a wide variety of things, ranging from the upkeep of streets and libraries to the cleaning of rubbish and the repair of sewage systems. Property tax, sometimes known as an ad valorem tax, is imposed on the value of the real estate or other personal property. Property taxes are usually imposed by local governments and charged on a reoccurring basis. For example, homeowners will generally pay their real estate taxes either once a year or as a monthly fee as part of their mortgage payments. Real estate taxes are often subject to fluctuation based upon a jurisdiction's assessment of the worth of a property based on its condition, location, and market value, and/or changes to the amounts apportioned to various recipients of the tax. For example, if residents of a community have voted to increase the millage rate, the amount per $1,000 that is used to calculate taxes, for a school system, homeowners could see an increase in the tax levied on their properties. Conversely, if property values have fallen due to adverse economic circumstances, home taxes may decrease. Your income is automatically segmented into several marginal components, each subject to a special tax rate. Let us know your opinion in the comment section below. This was all for today. Hope you liked the video. Don't forget to subscribe to our YouTube channel. Stay safe, and we'll be back soon with another video.